Hello, this is Brad Harvey. Welcome to our Ask the Advisor video series, where we answer your financial questions. Hello, this is Brad Harvey with Ask the Advisor. Another question that we're getting frequently is, what is the difference between a buy and hold strategy or a strategic strategy and something that's more actively managed? In the investment world, we talk a lot about asset allocation. Asset allocation is very simply, what percentage of your assets do you have in different asset classes? And then how often do you rebalance to those percentages will have to do with how active your portfolio is. For example, let's say you're a long-term income and growth investor and you want 50% exposure in growth or stocks, and you want 50% exposure in cash flow investments, things that are income generating. And let's say you start out with $1 million and you put $500,000 into each strategy, and you never change it again. In fact, you don't even really look at it. You just collect the income off the $500,000, let everything else ride. That's a buy and hold strategy. Now, sometimes we make jokes in the industry that that's a buy and hope, because sometimes portfolios don't age well without some supervision. Then you can also take a more active approach, which is saying, according to certain criteria, if the economy's growing, if unemployment's below a certain number, and we've had a certain number of consecutive quarters in the market, then I want to be overweight in growth equity. So now I may want 70% as opposed to 50%. Or if we head into a recession or some exogenous event occurs and we say, I want to trim that back. Perhaps I want 30% exposure in stocks and the rest in cash flow investments. Or as I'm getting older and closer to retirement, I may want to make changes to that overall allocation to reduce my risk and volatility. So that's the difference between a static or buy and hold strategy, which is I'm going to invest my money and I'm going to hope it does very well, or a more active approach, which is very much like driving a car or getting on a plane. You check the weather. If the weather's clear, hey, maybe we go a little faster. If the weather's poor, perhaps we don't go that day, or we pick a different route. That's the difference between active management and passive management. So this is Brad Harvey. If you have any questions you'd like for us to answer on Ask the Advisor, please send us an email. Thank you. Thanks for visiting our channel. We hope you found the information valuable. If you want to see more videos about investing, please click to subscribe. If you have any questions you'd like for us to answer, send us an email at him@riagroups.com. We would love your feedback.